Hello there. I'm Mitch Goldberg. I am with Client First Strategy. I'm a financial advisor, and you're watching my live stream called Be the Boss of Your Money. This is about personal finance, investing, business talk, and so many other related topics underneath that umbrella. I'd like to welcome you to my live stream. If you're watching this right now in the live, welcome. If you have any questions, please ask away in the comments. I would love to answer your questions. That, to me, is the best kind of content, and I really enjoy that. If you're watching this in the replay, I'd like to welcome you as well. Thank you so much. I promise I will always do my best to make watching my content worth your time. So we've got a couple of things to talk about. The election is over, but the vote continues. Stocks have rallied huge in just the last few days, more than making up for the market retreat the 2 weeks before the election. So it's not really a matter of what's going on. We know pretty much what's going on, but what we really need to do is figure out once and for all, what's the number one takeaway, the number one lesson for investors? It's really good. It's really important. And I think it's really interesting. So what's the number one lesson to take away? That's what we're going to get into. So I will just quickly roll the intro and then we're going to get right into the lesson. I'm just going to, as soon as I come back, I'm going to blurt it out. Okay. So here we go. Thank you so much for joining me. I'm Mitch Goldberg. If you're just joining me now, we are talking about the number one lesson for investors to learn from this election. The election day is over, but the vote has continued. It goes on. Hopefully we'll have resolution over the next 24 hours, but that's not what's really why I'm on right now. I want to talk to you about the market, but I want to talk to you what you should have learned. So here it goes. I'm going to blurt it right out. Personal finance. The number one lesson for investors to have learned from this nasty, crazy election season that we are just about out of is that you should make your investment decisions based on your own unique personal financial situation, not based on politics, what you think may or may not be an upcoming change to tax policy. These are not the things to make your investment decisions on. And we know that if we ever get a new regime in red, blue, etc., that every few years, whatever previous regimes did, it's changed in the next regime. This is what I mean. The number one lesson. So I'm going to show it to you in a graphical interface. And I want to make this a little bigger if I could. Oh yeah, this is going to be good. Check this out. This says it all. And I have a chart for you to check out. The number one lesson for investors to learn. It's all right here. You see this here? This is a chart. I can even make it bigger. It's still on the screen. Okay. This is starting the week before the election up until yesterday. Look at this. The market on the S&P 500. You see that? That's the S&P 500 right over here. The Dow Jones Industrial Average and the NASDAQ. You see these charts? What happened? Market went down. Worst week since the worst week in like 3 months or so. And it was a really bad week. The market was going to go down. Election uncertainty, potential blue wave, changes to tax policy. Look, whatever it is, look, I've often said, we in the talking heads love to come up with pretext. They see what the market did on a particular day or in a particular week. And then they say, well, it's because of this, because of that. And sometimes we don't find out why the market did something until some time has passed us by. Okay. But what you could see is the market came plunging down before the election and then it went up. And this is as of yesterday. But if you go by today, the major averages all skyrocketed again today. So, we'd be up, see where my cursor is up here. We'd be up here. We'd be up here. Okay. So the markets rallied huge. So, what did you get out of making changes to your investment portfolio last week and the week before? Did you sell something because you were worried that Biden would win the election and you're not supportive of Biden, you're supportive of Trump, and you're like, well, it's going to change things, it's going to be bad for business? And look what happened. Now, maybe today would be a good day to make some changes because after such a big rally, I wouldn't blame anybody for wanting to take a little risk off the table. As a matter of fact, after the rally we've just had, I think it would be downright prudent to take a little off the table. But there's a good way to take a little off the table and a bad way to take a little off the table. So let me stop sharing the screen. You could have just maybe rebalanced. You could have maybe had what you're going to need as far as your cash obligations well in advance, so you wouldn't have to worry about selling because of a down market. If you have cash needs coming up market or down market has nothing to do with that. Your cash needs should be available to you well in advance of when you're going to need your cash. You see that? So that's what the lesson. So that's the lesson from election 2020. Make your investment decisions based on your personal finance, not on the election. What good does that do anybody? Look at all the people who sold the week before the election and all the people who are buying everything back after the election. What I want you to do is to be the boss of your money, not your money, to be the boss of you. Okay. We've got a couple of comments out there. Let me see who is out there. We have Scott. Hey, Scott, good to see you. Thank you so much, buddy, for watching. I really, really appreciate you, Scott. Thank you very much. By the way, I'm following your dog on Instagram. It's like the cutest thing. I love it. So keep posting. And Frank is out there. Mitch, did you grow up in East Meadow? No, but there are a number of Mitch Goldbergs on Long Island. I think there's like 6 of us. Seriously, there's like 6 of us because every time I've ever bought a house and had to, apply for the mortgage, right? I have to sign an affidavit that I'm this Mitch Goldberg, not the other 5. So no, did not grow up in East Meadow. Although I'm near East Meadow often because of Bethpage golf courses. So it's a lovely place. Okay. Thank you so much for joining me, Frank. Really appreciate that. Even if I'm not a Mitch Goldberg from East Meadow. So this gives us a good reason to take a look at what happened real quick to the market, what's happening. And I want to just go over 3 quick thing. I just want to go over 3 quick things to review. There are 3 things to review when it comes to investing based on your personal finance. Let's take a quick look at how the market did. Share screen. We're going to wrap this up in a couple of minutes, so stay with me. Okay, we'll share screen. See if I can make this a little bigger. So you see that the Dow was up 540 some odd points, S&P up almost 70, and this is huge. NASDAQ up 300, 2.5%, building on the last few days. And then you have the Russell 2000 up almost 3%. Russell 2000 is a major average. It's the most important stock market index that investors don't follow. Okay, Frank has a quick question. Now, well, it's a statement. Okay, I could go with that. Yes, it could be a good time for that. It's tough to say. I don't really get into that so often. We're talking about a strategy of covered calls, and yes, I am very familiar with it. Would now be a good time to do that, maybe as a way to uh, take some money off the table, lock in some gains, and be willing to sell stocks if they're called away. I I have no argument with that if that's your strategy. Okay, so the Russell 2000 is a small cap index. Small cap stocks are more sensitive to the economy than large cap stocks. They're more because their revenues are more domestic sourced as opposed to international. And the VIX, the fear gauge, continues to come down. I would really like to see that below 25, but that's a good thing that it's going down. That is a good when you want the VIX to go down. Typically, when stocks go up, the VIX goes down because uh, think of the VIX as a feel good index. When stocks are up, the VIX goes down because investors feel better about the outlook. Okay. So let's take a look at the major sectors of the economy. These are the ETFs that track the major sectors of the economy. Building materials, technology had a big day. Financials had a weak day yesterday, so they had a really good day today. Industrials, communications. These are all the sectors that you want to see that shout out optimism, bullish economy. I would have liked to have seen energy go up, but there's just so much oil. I'm not even sure if you could get a read on the economy anymore from the price of oil. It's just oil is it's like I want to say like it's water, but it's such an oversupplied commodity today that I think even if oil demand goes up, I don't even know if that's enough to get the price of oil higher at this point because there's just so much of it and it's so easy to turn the drilling on and off. That used to not be easy, but seems like it's a lot easier these days. FANG stocks, Facebook, Apple, Amazon, Netflix, Google. These stocks continue to rock and roll. They had a soft patch last week and the week before, but they have more than made up for any losses. Microsoft, I believe that's a new high. Google, I believe, is a new high. Amazon, I think the new high is a little bit. The high is a little lower. Same with Facebook and Apple, but still they're very close to it, and they've been rocking and rolling. So let's just talk about let's go on. I'm going to stop the screen here, the share screen. Okay, it's a good time. It's a good time to review a couple of really important things that have to do with your investing based on your personal finance. The main things are your time. Your time. I'm going to get my fingers in here so I can say your time horizon, your risk tolerance, and your financial goals. All three of these are important. You can't have one without the other three. But your time horizon simply means time in number of years until a goal, right? So let's say money needed for college is 5 years away. It's a medium term time horizon, I would say, and you're not going to be fully invested. You'll probably have a portfolio that's somewhat moderated between stocks, bonds, and cash, with the expectation that the stock component will go down, the bond component will go down, and the cash component will rise as you get closer to that date. So your risk tolerance, if your goal is 5 years from now, is probably a lot lower than if you're than when your goal is 15 years away. So time horizon and risk tolerance are directly tied together. The longer your time horizon, the greater your risk tolerance, and vice versa. And then there's the financial goal component. And it's not just one financial goal. Well, what's the big goal? The financial goal is to be able to afford to live a desired lifestyle in retirement. Well, that's one goal, but there are sub goals. Sub goals like, well, I want to play golf. I want to buy a boat. I want to buy a house in a certain area of the country. I want to be able to fly, east and west or north and south to visit my children and grandchildren. Vacations, so there's lots of little goals within the big goal, and every goal and time horizon, to your goals, which then dictates your risk tolerance. These all have to be taken into account. So getting back to making a financial investing decision just based on the election, I think you're making a mistake. the the stock market is pretty tough to time. If you haven't heard, maybe some people thought, oh, I'll sell the stocks before the election and I'll buy them back when the market goes down. Well, you sold low and now you're buying back high, where now you're waiting for the market to go down again to get back in. And that could happen. That may very well happen, but it's not a position that you want to be in. My best advice to you, it's a general advice, but my thing that I want to stress the most is make your investing decisions uh, based on your own personal finance situation. This way, you'll make the investment decision that is best for you. Okay. That's best for you, not for anybody else, because it's based on your situation. Doesn't that sound better than just trying to uh, play the market for an election dip or an election bounce, which which looks like everybody got wrong? Yes, I know we talk about gridlock in politics, and that's good for the market. Maybe we won't, because we won't have a blue wave. That'll be good for keeping capital gains taxes lower, things like that. Look, this is all noise. I said a week ago that whoever wins, I've actually been saying this for weeks right here and Be the Boss of Your Money, that I think the stock market will go up whether Trump or Biden wins, because they're both expansionary. They're both expansionary, and they both want to spend a ton of money to keep the economy going. Okay. One might do it through tax cuts. One might do it through infrastructure spending or stimulus. Well, they'll both do it through stimulus, right? But they're both expansionary. So I think they would have both been good for the economy going forward. Now, there's a few things we have to take into account that nobody's really talking about. We're breaking now into bigger numbers for the number of new COVID positives in this country, over 100,000 daily now. So nobody's really talking about this stuff. And I think this does come back into the fore. So that does make me a little concerned about this dramatic rise in stock prices. Most of the rise in stock prices was just repealing the dip of the 2 weeks before the election. But if you were looking to take a little bit off the table because you feel you do have too much invested in stocks, I don't think now is a bad time to do that. But if you do have, based on your financial goals, a cash need over the next, let's say, 12 to 18 months, do you think that cash should be invested in the stock market, or should you take that money out now, well in advance of when you're going to need it? I think the latter, not the former, but that's just my own personal finance opinion. I think you agree with it though, right? All right. So last thing I'll say is basing investment decisions based on elections. Listen, when Trump won the election, in 2016, the overnight futures plunged. The stock market plunged when it opened the next day after the election. And then the stock market started to climb. And last I checked, President Trump is still the president. So this rally going on right now is still adding to his, stock market scorecard. So you did pretty well in the market under Trump. I have no reason to believe you won't do well in a stock market under Biden. The fact is, it's historically, over the last 120 years, the stock market has been positive under every single president, I think with the exception of two, with George W. Bush. I know some of you are saying Carter, but no, that's not true. George H. Bush and Jimmy Carter both had positive stock market returns during their one term in office. And there were not bad returns either. Okay. And I was also FDR, World War II. So think in terms of that. Think long term. Whatever happens now, I don't think it's going to really matter for investors a year from now. All right. That's it. That's all I got. I will be back Monday with a brand new live stream episode of Be the Boss of Your Money. If you have any questions for me that you didn't think of and you want to ask later, hit me up in the comments. You can certainly send me a DM. I'd love to hear from you, and I'll see you soon. Thanks.